Well, folks, there's a brand new concern revolving around Chinese EV companies, and it has all to do with just two words: profit margins. People are realizing that startup companies like Nio and Xpeng Motors, who have only been delivering vehicles for the past 4 to 5 years, are less profitable than a company that's been delivering vehicles for almost 20 years like Tesla. I don't know about you, but it looks like common sense is not that common, especially on Twitter and social media. And it has all to do with this one graphic that was shared by VisualCapitalist just a few weeks ago. A graphic that seems to show just how ahead a company like Tesla is compared to its nearest competitors like GM, BYD, Toyota, or Xpeng Motors and Nio. Although this chart looks extremely enticing and valid on its surface, there's a lot of context and history that needs to be accounted for before evaluating companies on such a basis, which is exactly what I want to dissect in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's get right into it. As you can see, this chart discusses the profit margins on a net basis from the third quarter of 2022 of some of the world's biggest EV manufacturers. Now we have pure EV manufacturers like Tesla, Xpeng Motors and Nio on this chart, but also ICE manufacturers like Toyota, BYD and GM, which are obviously entering the EV market at a rapid pace with new product launches and are starting to see positive margins on their vehicles. Now don't get me wrong, there is no inaccuracies in this chart, but the way that this data for profit margins was gathered and the potential discrepancies in comparing these companies is what I want to discuss. You see, although on the surface that graphic looks really enticing and really valid, you have to compare the companies on a one-to-one basis to truly understand whether or not one business is more successful than the other. Tesla has been in the business of selling electric vehicles for almost 20 years, whereas a startup like Xpeng Motors or Nio or even ICE manufacturers like GM have only started to mass produce EVs over the past 4 to 5 years. Timing is a pretty important part when it comes to startups like Xpeng Motors and Nio, which is why they ended up starting at a time when the EV industry was starting to inflect big in China back in 2017 and 2018. As we all know, volume dictates profit margins for auto OEMs in the long term. The more scale you have, the more deliveries you have, the better economies of scale can play into your business, allowing you to either increase pricing or reduce operational costs per unit of vehicle made. Tesla delivers over 1 million vehicles per year, whereas Nio and Xpeng cumulatively have only delivered in their entire lifetime around 200 to 300,000 vehicles. So this obviously means they're going to be more underwater on each vehicle they sell. These margins are only going to improve with scale. And so putting these companies on the same page for net profit margins as Tesla is like comparing the resume of a 30-year-old to a 19-year-old that might be competing for the same job in the same industry. Obviously, the 19-year-old is going to have less experience, less money in the bank, and less skills than the 30-year-old. And that doesn't necessarily mean the 19-year-old is a worse investment from an employer. And that brings us on to another misleading factor regarding this graphic, which is the fact that it's comparing the net profit per vehicle, not the gross profit per vehicle. The difference between these two is obviously gross is when you subtract the cost of goods sold from every vehicle you make, whereas net profit per vehicle is just the amount of vehicles you deliver divided by the operating and net income of your company. Now, the reason why this is not a good idea is because gross is what actually dictates your margins per vehicle. Your net profit, on the other hand, can depend on the operating expenses of your company. Right now, Nio and Xpeng are expanding at a faster pace, meaning they're investing in more capital expenditure to fuel their growth, whether that be establishing supply chains, building more factories, more assembly lines, or just investing more in customer acquisition strategy. Tesla is in a completely different space because they already had a customer acquisition strategy in place since like 2010. They don't have to invest in those anymore, meaning their operating expenses are not going to grow nearly as fast as Xpeng Motors or Nio, meaning the net profit margin is obviously going to be skewed in favor of a business like Tesla. And that's obviously not even to mention the fact that Tesla has been selling vehicles for 10 years in the same segments that Xpeng and Nio are currently selling in. So it makes more sense to compare the profit margins and the operating expenses of these companies at a time when they were selling a similar volume of vehicles. As you can see, Nio, for example, sold around 43,000 vehicles in 2020, up from 20,000, meaning they're growing at a faster rate because the deliveries are already starting off from a much lower point. And so if you look at this chart, you can see Tesla was around that 43,000 mark in 2015, meaning it made more sense to compare Tesla's gross profit margins in 2015 to what Nio was selling, let's say, in 2020. And as you can see, if you look at the data, going back to 2015, Tesla's gross margin was sitting around 22%, with their operating and profit margins in the negative around -17 and -22%. Meanwhile, if you compare Nio's 2020 annual profit margins, you can see their gross came in at around 11%, with their operating at -28 and profit at -34. So this puts their net profit margin per vehicle on a much more comparable basis to Tesla. But obviously, you guys might have noticed that Nio's expenses were actually still a little bit worse than Tesla's from 2015 back in 2020. And there's obviously a couple of reasons for that. I'm not going to try to make excuses here, but the Chinese EV market is a lot more competitive today than it was back in 2015. There's way more products and a record amount of companies making electric vehicles. This naturally means there's less pricing power for companies in this space that are startups because you have to prove yourself to the customer, and that reduces margins for those automakers. And it's also known that selling in China has historically been less profitable than selling in Europe or the US because the Chinese consumer is much more sensitive to price fluctuations. The Chinese economy is not driven on debt like in the US. There's much stricter regulations, and people are not as much consumer expenditure driven in Chinese households. Meaning, to get somebody to switch from an ICE vehicle that they've been so comfortable with in their entire lifetime to an electric vehicle is miles more harder in a state like China. Whereas in the US and Europe, incentives and the demand for innovation and entrepreneurship drives many people to buying EVs because obviously they are cool and because of their software integration. And it's also been known that Chinese markets are much more difficult to raise money from, and Nio and Xpeng only started raising money from US markets in 2020, meaning they had access to low interest capital only for a few years. And because of that, these companies have to expand and invest in their production assets much more aggressively than established companies like BYD, GM, Toyota, or Tesla, who've had factories and supply chains established for almost 1 decade. That's a big reason why the net profit per vehicle for these companies is so much far off from all the other companies that are kind of accumulated around this $1,500 level. And as you can see, a big portion of your range in profits per vehicle is driven by the car segments you're offering, whether that be midsize SUVs, luxury sedans, or crossovers, because each model has its own profitability curve. That's something that allows Tesla to have such a wide range of profitability, also with the fact that they have more features in their vehicles like FSD and software app integration. That is something that's allowing them to have a higher profit margin than competitors. But that's something obviously Nio and Xpeng can also integrate into their offerings in the Chinese market. So it's not off the table for these companies to be able to expand and grow profitability over the next few years. And that is obviously something that graphic just does not account for. Just because a company is not profitable in the short term does not necessarily mean they won't be profitable in the long term. That, I think, is something social media tends to get very wrong when comparing a lot of these EV automakers. Startups are obviously going to have a tougher time with profit margins, but just because a business like Tesla has been in this market for such a long time, was the first mover, does not mean that competitors have a lesser chance at creating their own market presence and their own revenue streams. And so although I appreciate the message that this graphic is trying to send to most consumers, I think this is a misleading graphic in many aspects. Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.